Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day. The National Payments Corporation of India's international unit has signed a string of deals over the past 2 years with foreign companies and central banks to internationalize India's homegrown digital payment system, UPI. Most of these deals will help Indians traveling abroad to pay using UPI, while Nepal has adopted UPI as a domestic payment system. Some other agreements relate to cross border payments. This raises the question: can the UPI payment system become a global service? A following report tries to answer.
In November 2019, Alphabet-owned Google wrote to the US Federal Reserve asking the American Central Bank to design its upcoming instant payment system FedNow on the lines of India's Unified Payments Interface or UPI. It said that an open payment system fosters collaboration between technology and financial service providers, adding that India's approach attained amazing results for banks, consumers, and other players within the payments ecosystem. In 2021, UPI processed around 39 billion transactions, totaling $940 billion, equivalent to 31% of India's GDP. As if on cue, in August 2020, the National Payments Corporation of India, which operates UPI, launched NPCI International Payments, a subsidiary tasked with exporting NPCI's indigenously developed offerings like UPI and the RuPay card network to foreign markets. Over the past 2 years, NPCI International Payments or NIPL's effort to widen the reach of UPI in international markets has borne fruit. On Monday, NIPL entered into a partnership with European Payment Services Facilitator Worldline to allow Indian travelers to pay through UPI on the latter's point-of-sale machines across Europe. The first target markets for the facility are Belgium, the Netherlands, Luxembourg, and Switzerland. It will be expanded as Worldline's QR code-based mechanism is rolled out in more European countries. Similar collaborations were recently announced with British payment solution provider PayExpert, UAE's NeoPay, and France's Lyra network. NIPL's biggest success came when Nepal became the first country outside India to adopt India's interoperable real-time digital payments model earlier this year, bolstering its person-to-person and merchant payment transactions. Last year, Bhutan opted to deploy UPI specification QR codes, while Malaysia's Merchant Trade Asia allowed sending remittances to India through UPI. The central banks of India and Singapore had also announced plans to link Singapore's PayNow and UPI, which would enable users to make instant fund transfers directly from a bank account to another between Singapore and India. Last month, global payments infrastructure group TerraPay announced a partnership with NIPL to allow Indian customers and merchants with an active UPI ID to conduct cross-border payments with QR locations enabled by TerraPay globally. NIPL's partnerships are likely to bring down cross-border remittance fees, enable seamless cross-border merchant payments, and empower Indian travelers to avail homegrown payment channels abroad. India received $87 billion as remittances in 2021. While NPCI's global deals have largely been with private players to benefit Indian tourists, can India get other countries to adopt UPI as a domestic payment solution?
There is no doubt that UPI is a revolutionary technology, which is truly an open architecture system. It has truly democratized payments by allowing non-banks to actually acquire both customers and merchants, which is at the heart of UPI's growth. So I think the primary value proposition that NPCI needs to sort of take to governments across the world would be, I think, on three parameters, right? How can digital payments potentially help that particular economy, right, in terms of driving a greater share of personal consumption expenditure onto the digital fold? How does it help the SME sector in the economy by accepting digital payments, thereby kind of expanding the tax net, allowing the country to actually have higher tax collections? Thirdly, how does it benefit the stakeholders in that particular country at large, be it the central bank, be it the various financial institutions, and actually help them lower the cost of receiving and sending payments? Right. The second piece is that how can it coexist with existing digital payment infrastructure. If you, for example, take UPI to a country like Singapore, which has a plethora of QR codes today, right? And all of them are closed loop QR codes. And most of these countries are thinking about an architecture which allows them to link these disparate QR codes into one interoperable framework, which is exactly what UPI succeeded in doing. So that can be the other piece of the story, that UPI can be that underlying backbone which can connect existing QR schemes in the country.
The NPCI has clear selling points to convince other governments of UPI's economic benefits. If India plays its cards right, it has the necessary ingredients to help co-create payment systems with participating nations.
As UPI tries to find a foothold worldwide, back in India, another service is trying to scale up. Airtel and Reliance Jio launched the much-awaited 5G services in select cities. The rollout has not been as fast as expected, and most users can't experience the service yet. A concerned government even summoned the top telcos, smartphone makers, and other infra providers to understand the reasons for the slow rollout. Our next report explains the reasons behind the delay.
You flaunt one of the 70 million odd handsets in India that are 5G enabled. You live in one of the select cities where 5G services have been launched. But still, you can't enjoy the blazing fast data speed promised by the next gen technology. Why is that the case? Well, it's because many 5G smartphone models currently lack the software updates needed to enable 5G services on them. But there are a few lucky users too. The India Cellular and Electronics Association indicates that over 150 5G phone models have already been enabled with a patch across operators. However, that doesn't include select Samsung handsets and all of Apple's 5G enabled iPhones. 5G enabled smartphones from OnePlus and Google also lack software support for the network. This has effectively left most Indian users with premium devices out of the 5G network. On Wednesday, the Department of Telecommunications had summoned both telecom companies and mobile device makers. The agenda included enabling 5G services for in-use handsets and giving the early adoption of 5G a push. The meeting followed complaints from telcos that device makers have not released their updated software patches, which will allow users with 5G-enabled devices to access the recently rolled out service. Telcos allege that customers are unable to access 5G services on their handset, even though the service is available in Delhi, Mumbai, Kolkata, Chennai, and Varanasi. However, a section of smartphone makers believes that telcos are being unfair to them. They say that even though telcos announced the launch of 5G services in the week of Dussehra, only a few 5G towers are currently operational. According to device makers, at least one telco in Delhi has only a handful of 5G towers with very limited coverage. Their argument is that without the minimum required number of towers in a circle, availability of 5G services will remain poor even after software upgrades. They also say that sending over-the-air upgrades to all 5G handsets will take some time because software patches need to be tested on various networks first. However, there is some good news. Ahead of the DOT meeting, Apple said that the software update needed to enable 5G services in iPhones would start rolling out in December. The iPhone 14, iPhone 13, and iPhone 12 series, along with the third generation iPhone SE, are compatible with 5G. Hours after Apple's statement, Samsung also announced that it would roll out software updates needed to enable 5G services in its compatible devices by mid-November. Presently, only about 9% of all smartphones in India are 5G enabled, but their adoption is growing rapidly with shipments of 5G enabled devices speeding up. According to cyber media research, 27 million 5G compatible devices were shipped in India in 2021, making up 16% of all smartphone deliveries. However, between just April 2022 and August, 20 million 5G devices were shipped, accounting for 31% of all smartphone deliveries. Within that period, Samsung came out as the top 5G compatible brand in India with a 26% market share. Xiaomi and OnePlus were second and third respectively, with a minor difference in the number of units shipped by them. And there are other reasons why you may have difficulty finding 5G service. Reliance Jio's 5G service is available in Delhi, Mumbai, Kolkata and Varanasi. But it is only available to users who have been invited. Airtel 5G Plus has been launched in 8 cities in a phased manner. Its customers in Delhi, Mumbai, Chennai, Bengaluru, Hyderabad, Shiliguri, Nagpur and Varanasi will be among the first to experience the new technology. So, why have some device makers lagged behind in enabling 5G?
It's not simple like the case with 4G. What happens in 5G is it's not a one size fits all. You need software upgrades which are different for different scenarios. For instance, Airtel deploys non-standalone architecture for 5G, whereas Jio has a 5G standalone architecture in place. So the upgrades are different for different smartphones.
These global OEMs, they are, at the end of the day, they are tier one OEMs, and they go by very stringent testing and parameters only after which they approve any update pushes. However, this doesn't mean that the other OEMs have done half the job, but what apparently looks at times also is users in the same area on the same devices. Some of them are able to connect, some of them are not able to connect, which means there is some issue with the existing updates. And I'm sure in due course of time, we will see those OEMs also sending an updated push.
It also appears that some Chinese device makers have stolen a march on the likes of Samsung and Apple in this regard.
I can say there has been some, miscommunications or lapses in coordination. What I can say is the likes of these Oppo and Realme and Xiaomi, all of these brands had partnered with the likes of Airtel and Jio to test out their equipment, test out their products, test out their smartphones, and some OEMs, have not done that, and similarly, you can see the results.
Whether it's the fault of the telcos or the device makers, users will be more concerned about knowing when they will be able to enjoy the full benefits of 5G. Building and expanding a robust 5G network is a Herculean task involving large investments. Indians, at least in the cities, can expect stable, high-quality 5G coverage by the end of 2023 or early 2024.
Even as the 5G rollout is hobbled, there is no such worry for the world of realty stocks. After withstanding the pandemic-wrought downtrend, the sun shines brightly upon the realty sector on the back of strong affordability, upbeat demand, and manageable inventory levels. But will the rate-sensitive sector face a challenge because of rising interest rates, or will it brave through the rate hike storm? We explain this in our market segment. The real estate sector is back in the spotlight after housing sales registered strong growth in the July-September quarter of 2022. According to ANAROC data, the sales of residential properties across Delhi NCR, Mumbai metropolitan region, Chennai, Kolkata, Bangalore, Hyderabad and Pune rose 41% year-on-year to 88,234 units. New launches too climbed 45% year-on-year to 93,490 units in these 7 cities during the recently concluded quarter. However, after the pandemic, the sector stands vulnerable to successive rate hikes. Against this backdrop, analysts believe that the upbeat housing demand would override rate hikes in the long run.
So we believe that the real estate sector has done well recently. The demand environment remains strong, and a significant part of the ready inventory is already absorbed by consumers. The current ready inventory in the market is at very comfortable levels, and this has released significant amount of capital for the real estate companies. This bodes well for new project launches by the organized real estate companies, and the real estate stocks thus should do well in the near and medium term. There is some concern in a pocket of the market that the recent rate hikes will have impact on the demand scenario for the sector. We are firmly of the belief that wage growth, the rate of wage growth as well as high employment levels are key factors driving this demand, and some interest rate increase will not have any significant dent on this growth prospects. Some names which we like in this space include Oberoi, Mahindra Life Spaces, Godrej, and DLF. We believe these names should do well going ahead.
Moreover, investors have turned positive on the sector in the second quarter of FY23 after relative underperformance in the previous quarter. At the bourses, shares of Brigade Enterprises, DLF, Godrej Properties, India Bulls Real Estate, Oberoi Realty, Prestige Estates, Phoenix Mills and Shobha have surged up to 28.3%. In comparison, the S&P BSE Sensex and Nifty 50 have gained over 8% each in the July-September quarter. That said, experts fear that incessant rate hikes would inflate costs of raw materials, which would elevate property prices and dampen demand. Anuj Puri of ANAROC Group says, this whammy of rising rates comes along with the inflationary trends of primary raw materials, including cement, steel, labor, etc., that have recently led to a rise in property prices. These factors will impact residential sales that did reasonably well in the first half of 2022. Since the present interest rate continues to be at lower levels than 10 years ago, more rate hikes carry the potential to derail demand momentum, warn analysts.
As we move from the monsoon season onto the festive season, making large purchases such as cars and homes can be seen as relatively auspicious. And this should increase demand, at least in the near term, especially aided by the sweeteners on offer by developers as they attempt to woo prospective home buyers. Animal spirits are also pretty resilient, and this can be seen and reflected by the Indian stock market, which has remained fairly robust despite the various global macro headwinds. Post-COVID, there's been a pretty decent catalyst in terms of increasing demand for residential homes, especially since space was a premium. People rather sacrifice and swap location for extra space, and this was further aided by the ability to work remotely. The real estate market, of course, is now a little more affordable. Real prices remained relatively flat over the last decade, and while wages have increased, real estate is also seen as a practical and a tangible investment. And lastly, until recently, we've been living in a pretty low interest rate environment. And even with the recent rate hikes, it can be seen as really relatively low compared to 8 to 10 years ago. However, the rate hikes have come, and this will have an impact on the ability as well as sentiment of prospective home buyers. And there may be further ones to come as central bankers look to delicately balance their emphasis on inflation, growth, as well as currency rates. So it's pretty much a case of wait and see to see if there'll be further rate hikes and more costs to home buyers.
As regard today, rupee movement, foreign flows, and crude oil prices will guide domestic markets on Thursday. Globally, crude inventory report, US inflation, and employment data will be closely tracked. Realty stocks may be sensitive to rate hikes, while telecom stocks may reflect the difficulties in expanding 5G services. And what about equity funds? How should you select one, and what should you keep in mind? Our next report answers this question.
An equity fund is a mutual fund scheme that invests predominantly in equity stocks. To select an equity fund, one should start with comparing the fund's performance against its benchmark and its category average return. Compare these returns over 1 year, 3 year, 5 year, and 10-year horizons. Give higher weight to longer term performance in your assessment. Also, do a calendar year-wise comparison of the fund's performance against that of its benchmark over the past 5 to 7 years. Now look at the fund's performance during the years when its benchmark gave negative returns. Did the fund fall less or more than its benchmark? Ideally, you want a fund that not only offers good returns in rising markets, but is also able to contain the downside risk by declining less than its benchmark. Next, check the number of stocks that the fund holds. One that holds only 15 to 25 stocks would be a concentrated fund. A fund that holds a higher number of stocks would be a more diversified offering. The next step is to check out the fund's concentration in the top 5 sectors, that is, the percentage of the portfolio that the top 5 sectors account for. By comparing this figure with that of its peers, you'll be able to assess whether its fund manager runs a concentrated or diversified strategy. You may also carry out a similar assessment for the level of concentration in the top 5 stocks. Concentrated funds are capable of delivering high returns, but are also likely to be more volatile. Investors with lower risk appetite should prefer more diversified offerings. Next, check the turnover ratio of the fund. A low turnover ratio compared to peers means that the fund manager has a tendency to buy and hold stocks. Turnover ratio indicates that they churn their portfolio more. This could either mean they follow a momentum-oriented strategy, which is fine if it works, or that they do not know what they are doing and hence chase stocks that are rising. Also compare the expense ratio of the fund with the median for the category. A high expense ratio will make it more difficult for its fund manager to beat the benchmark. Finally, compare the fund on a measure of risk-adjusted return, such as Sharpe ratio, over a 5-year period. Compare this number with that of its peers. You want to go with a fund manager that is able to generate high return while taking lower risk. Once you have assessed a fund on these parameters, you'll be able to pick a fund that has performed across market cycles. There is no guarantee that a fund that has performed in the past will continue to do so in the future. Nonetheless, you will avoid the mistake of selecting recent winners. So once you have picked a fund after such a detailed assessment, stick to it across market cycles, that's 7 years at least or more.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Market performance data tells us that the market typically completes one full cycle in 7 years. Experts say that investments do make money in 7 years. So hold on to your choice of equity funds and do remember those wise words. Mutual fund investments are subject to market risk. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.